Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. So the stock market today actually went up as expected. As we were anticipating yesterday, the S&P 500 is up 1.8%, the NASDAQ is up 2.14%, and the Dow up 1.4%. Let's take a look at the stock market map. Really green all over the place, except for energy. I did warn yesterday about that nasty rejection on oil that we've seen and taking out the previous week's low. And we've seen that materialize today with more selling into oil. Everything else really is green. Let's take a look at the different sectors leading today. Utilities and consumer cyclicals. This is an oxymoronic development because utilities is one of the most defensive sectors and consumer cyclical is one of the most offensive risk-on sectors. So this was kind of a strange day today, but when the market is really choppy, you can expect days like this where the entirety of the market moves to the upside. Really the only exception was energy. Let's take a look at the S&P 500 daily chart. Look at this beautiful descending wedge. We talked about this beautiful descending wedge structure yesterday and that it was bullish and it was indicating that a small bounce to the upside was coming. That small bounce came today. Let's take a look at the 2-hour chart, guys. Look at this beautiful double bottom. We talked about this beautiful double bottom formation with a lower low on the price action and a slightly higher low on the PPO, okay? So this beautiful divergence is what led us to go long right over here. I did in fact take some risk off the table today, guys. After such a huge move to the upside and playing counter trend rallies, you have to be very tactical. So I did take some off the table today. By the way, guys, if you want to support me, you can join the trading community. It's $20 a month and I do post every single trade and investment as well as technical analysis in real time in the trading group. You are all welcome to join us. The link will be in the description below. And so, guys, we're pretty much within spitting distance of that $400 resistance level on the SPY. I do suspect that we will see that level getting hit either tomorrow or Friday, and I expect a lot of bears to pile back in, try to push the price back down off this $400 level. We'll see if it holds or not. Medium term, guys, I'm still bearish. Very short term, I was bullish and we've already seen the move to the upside. Really, the remaining upside left is just about $2 in my opinion. $2 to $3 on the SPY ETF. Not sure if it's really worth any more long side trades right here. So I'll be actually switching over and looking for opportunities to short the market in the short term. In the long term, guys, I've actually been buying some stocks, including AMD. I've also been buying some long dated options. Again, guys, all of my trades and investments are in the trading community. Check out the link in the description below. One other very interesting indicator that I talked about yesterday was the smart money indicator. Below, guys, this blue and black chart is for the HYG, the high yield bonds, the big money bond traders. And above is the S&P 500. The S&P 500 or the stock market is considered dumb money, and the bond market is considered the smart money because it's such a larger market, so it drives the momentum. Look at this. We noticed that every single time we've seen a divergence where the HYG put in higher lows while the S&P put in lower lows, we've seen that divergence resolve to the upside. This happened back here, right? The HYG was putting in higher lows while the S&P was putting in lower lows, and that resolved to the upside. Exact same thing happened here and again here. It also happened back here. I did not mark it, but it also happened back here. If you can notice, guys, 1, 2, 3 higher lows, 1, 2, 3 lower lows, okay? And that resolved to the upside in a very quick bounce, just like what we've seen today. And I did in fact draw a lot of parallels between this period in time right here and this period in time right here. This period came right after the earnings, Q1 earnings. This period came right after the Q2 earnings. We had a very strong bear market rally. We've had a very strong bear market rally. We've seen significant selling. And we had a descending wedge that resolved to the upside. We had a descending wedge that is resolving to the upside. And so, guys, it remains to be seen whether we will be able to take out the $400 level and try to test the 407 level right here and possibly get rejected there, or possibly just get rejected at $400 and continue to the downside. Again, guys, medium term, I'm still bearish. Very short term, I've already taken advantage of this move and I took profits today. Now let's take a look at the triple Qs. Again, beautiful descending wedge, guys, that broke out to the upside. We're still nowhere near the resistance level. This resistance line right over here for the triple Qs, right around $300. We might see that getting hit tomorrow and get rejected. We'll see. We do have Fed Chair Powell speaking tomorrow, guys, so be very careful. He'll be speaking at 9:10 a.m. So right around the market open. We'll see if we gap down tomorrow or gap up. I'm not sure whether the market is going to like what he has to say. Overall, this short bounce to the upside might come to an end, and it might just be a function of volatility and nothing more. And so we'll be watching for more structure to develop to see how this resolves. Again, guys, look at this volume. Big sell side volume, small buy side volume. On the triple Qs, guys, look at this very low volume compared to the selling in the prior days. So again, I do not trust this rally. I just played it tactically and I got out. Let's take a look at the VIX, guys. Again, as expected, I expected the VIX to calm down, begin to find support right around here at the 50% Fibonacci retracement level. Look at that. We got right at that level. We might test the 62% retracement level. We'll see if we do that or not. Again, there might be some just tiny little bit of steam left in this rally. We'll see. Let's take a look at the dollar index. Big red candle today allowed the stock market to see some buying action, some green today. And I did actually take a look at this yesterday, and I did warn about this. Look at this, guys. We had consecutive, right, higher highs, while on the PPO we had consecutive lower highs. And it was very clear to me right here, we had a double top on the dollar index with a noticeably lower high on the PPO. And that's when I alerted everybody in the trading group that, okay, guys, the dollar looks like it wants to break down, and it did break down. This is what it looks like in the trading room, guys, right here. Don't mind the time. I'm at a completely different time. I'm at UTC +3. That's why it says 5 p.m. This was actually about 9:20 Eastern time, 9:20 a.m. Eastern time. So everybody, DXY, the dollar index, is slowing down, forming more bearish divergences, might be forming a short-term top here and reversing to the downside. I pointed out the double top right here. And I pointed out the double top on the price action. This is what the trading room looks like, guys. We have trade alerts, trade ideas, investment ideas, as well as a bunch of more rooms that you won't be able to see here for members to exchange ideas and news and discussions and all of that good stuff. Now let's take a look at the 10-year yield, guys. Still very obvious higher lows, higher highs, right? This little pullback today is what allowed the stock market to see some bounces to the upside. Overall, still the trend in the 10-year yield is very bullish, which means it is very bearish for the stock market. As long as this continues to push to the upside, that will continue to compress PE ratios on the stock market, compress valuations, and bring the stock market down. The 2-year yield, again, a lot of chop here, guys, a lot of chop. It might be slowing down. I'm seeing some bearish crossovers here, a lot of slowdown in the momentum. We had this significant breakdown after this ascending wedge. We'll see what happens with the 2-year yield here, if it calms down or if it just keeps chopping about. Let's take a look at gold. Gold is showing some bullishness here, guys. One beautiful bullish engulfing candle. A bullish engulfing candle, guys, is a candle that opens below yesterday's low and closes above yesterday's very top, right? So it completely engulfs the previous candle. This was the previous candle, and this is the current candle. It completely engulfs the previous candle. This is a bullish candle formation, but it's not enough in my opinion, because we had one just like it back here. And so I need to see more structure. In my opinion, I need to see one lower low in gold. I need to see one more sell-off in gold. Take out these lows, take out these lows, form a nice divergence, one more divergence, and a move to the upside. That would be my ideal entry. Let's take a look at Apple, guys. Apple continues to show weakness relative to the rest of the stock market. Remember, the triple Qs are up nearly 2% today. Not nearly, over 2% today, right? 2.14%. And Apple is up just 1% today. We did have the Apple event, but regardless, guys, from a technical standpoint, Apple was outperforming the stock market in this major bear market rally, and this happens in every bear market that I've ever seen since Apple was in existence. And we had this nasty rejection of this resistance line. I did warn about this, guys, back here on the 17th. And now we're seeing Apple considerably underperform the stock market, underperform the triple Qs, and underperform the S&P 500. Let's take a look at Tesla. Tesla is a completely different story. Tesla has been actually outperforming the triple Qs and the S&P. So we're seeing a little bit of strength into Tesla overall, guys. I think Tesla will continue to chop about. Very short-term target is right around $288 to $290 overall. I am still, from the medium and longer term, still bearish on Tesla until we hit the $250 level and revisit these lows right over here. Let's take a look at seasonality. The very first week of September tends to see some buying pressure. We've seen that this week, especially today. We might see a continuation of that rally towards the middle of September, right around the 13th, 14th, something like that. And after that, we will see one more leg of selling if seasonality pans out again, as it has in the past year. Let's take a very quick look at fear and greed. Junk bond demand is actually rising, right? When this graph moves up, it means junk bond demand is declining. When this graph is moving down, it means there's more risk appetite in the market. So we're still seeing some more risk appetite after that massive sell-off. Safe haven demand, stocks, and bond performance. When this chart is moving downwards, that's when bonds are outperforming stocks. That's when big money is fleeing to safety. And when you see stocks outperforming bonds, that's when big money is risk on. And now we're seeing a little tiny rejection. Even though, guys, we've seen that nice bounce today, we've actually seen bonds beginning to outperform the stock market again. So we're seeing smart money begin to position out of the market, and that's one more reason why I had to take my profits and close some of my positions. Now, market volatility, guys. Market volatility is calming down. We are still above the 50-day moving average. We might touch that 50-day moving average tomorrow, and it may act as support and propel us even higher on volatility. The put to call ratio is calming down. It has reached above 1, the 1.01 reading yesterday, and today again 1.01. And usually, guys, this is a contrarian indicator. When you see a lot of people buying puts, you want to actually be bullish. And when you see the put to call ratio decline, that's when you want to be bearish. So some mixed messaging here, right? Big money is bearish and small money is also still bearish. And that's kind of where you see the worst of both worlds. That's when you see selling into selling, and really bad stuff can happen potentially. Let's take a look at max pain. Max pain for the end of this week is at $397. Yesterday it was at $400. I did not show this chart yesterday, but yesterday the max pain was at $400 on the S&P 500. Max pain, guys, is the level at which market makers make the most amount of money and option holders lose the most amount of money. So from a market manipulation point of view, market makers need the S&P 500 to close at $397 by the end of the week to make the most amount of money. This level, guys, changes in real time. It was at 400 yesterday. It is now at 397. And we might see it change again tomorrow. So we'll see. We might close the week at 400 or something like that. We'll see what happens, guys. Again, tomorrow, guys, we'll have Fed Chair Powell speaking. We'll also have some jobs numbers. Friday, we'll have more Fed speakers come out. And Monday, we'll have the consumer inflation expectations for August. And Tuesday, we'll have the dreaded CPI numbers coming in. And actually, guys, I think CPI will come down meaningfully. We're seeing oil collapse, right? Look at this massive dump in oil, guys. I did warn about this yesterday and the day before. As soon as I saw this nasty, absolutely disgusting rejection of the 50-day moving average, it had all the hallmarks of market manipulation. We had this nasty bearish candle that closed below the low of the previous day. And on the weekly chart, we had a new low. And I did warn about this, guys. I said, look at this. We rejected at the top. We closed near the bottom. This consolidation is no longer looking bullish like this one, because this consolidation resolved to the upside. This consolidation resolved to the downside, taking out previous lows. And even when OPEC Plus came out and cut production by 100,000 barrels. I did say that was nothing. They reversed the production increase of last month. They just reversed that. And so that was nothing meaningful. And so really, guys, we don't have any meaningful support for oil all the way down to these levels, guys, at 85 bucks. So we might see more weakness into oil, and we might see oil chop around for a little while longer before continuing to move to the downside, where I suspect a lot of buying for oil at these levels in the mid 60s for Brent and low 60s for WTI. That's it, guys. That's all I have for you today. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.